Hi there, Serial Trader here. It looks like it's about time to do some commentary on the broader market. And here we are looking at a chart of SPX, so that's the S&P 500 index. Now, if you went on the weekly multi-year time frame, you could certainly make a case that, there are 5 waves up at multiple degrees of trend, and the market has hit its absolute top at 28.72.87, and now we're rolling over into a bear market. Now that's a little early to make that case at this point, in my opinion. And in the last multiple years, there have been many instances where it looked favorable to try and do that, and you were proven wrong again and again. And if you really tried to take a big short position with that in mind, well, you would have had your face ripped off every time. But that's not to say that eventually this bull market won't roll over and turn into a bear. But from a trading perspective, it doesn't really matter. What we're looking at is the patterns that we have in front of us. And that's what I'll be discussing here. So, from our so far all-time high at 28.72.87, we have what can be considered a 1, 2, 3, 4, 5 down from the highs, and that made the current low of this pullback to 25.32.69 in what could be either considered a wave 1 or A down. Now we've had a very significant advance in what could be considered an A up, B down, C up for either a wave 2 or B. And I don't have the Fibonacci retracement drawn on here, but here, let me just bring that up momentarily for you. And you can see that we did a near perfect 78.6% retracement of the initial decline. So that's deep, but that's certainly palatable for a wave 2 pullback. Wave 2s are often deep. They often trick investors or traders into thinking that the trend has turned back up, when in fact it's just a partial retracement, only to set up for another leg down. So let me get rid of that retracement there. Okay, and now, well, what can I observe here? We're breaking below the support there, which a lot of people were watching. So that's an early bearish signal. Still quite a ways to go before we actually test those February lows, but off to a reasonable start. I will remark there's a significant chart pattern here. It's called an island reversal. I've highlighted it with this yellow square, or rectangle, sorry. And that's when you have a gap up, and then a congestion or a trading range, and then followed by a gap down, and then neither of those gaps actually got closed. There's just a clean space in between those two price gaps. Now this gap came very close, okay, between these two price bars, but if you look, there actually is a small gap there. Now, a gap up followed by a trading range, then followed by a gap down. Support must hold, or this powerful chart pattern can be confirmed with large downside to follow. Well, I'd say the early signs are leaning towards it having pretty bearish follow through here. Although if you went on the shorter term time frames, we're extremely oversold, and there could easily be a pretty strong short term bounce at least. It'd be extremely bearish if this other gap that formed today also remains unclosed. Then you'd have 2 gap downs in a row. That can really signal some strength to the downside. Still a little too early to tell. What else is there to remark? Okay, so on the MACD on the daily, obviously that initial move down caused the trend to be down according to MACD on daily, as both these moving averages went below the zero line. The recovery, although strong on the chart, basically just kind of danced around the zero line, and now it's rolling back over down. So that's fairly bearish looking according to MACD. And RSI became oversold on that initial move down. But during this recovery, despite being quite strong, RSI only recovered to the 60 level. And that is actually right within the range of RSI bear market resistance using the range rules. So that range between 50 and 60 after a significant move down often provides what's called bear market resistance. And we reversed right off that 60 point on daily RSI. So that's worth noting. What else can I remark? Okay, so as far as a trade setup here, if you weren't already short, definitely pretty oversold short term to open up a short position. but I wouldn't be overly confident going long either, other than for, intraday short bounces. From kind of a larger swing trading perspective, if this low actually gets broken, you can expect at least a fairly significant follow through before a bottom is found in wave 3 or C. So going short on a break or buying puts on a break of that February low would probably pay off, but be ready to take your profits quickly, because at that point it will be very oversold, and the bounce could just come at any point. But depending on how far it breaks down after it breaks that, if it does, will determine whether it should be viewed as a wave 3 or C. There's just not enough information at this point to determine that. So this may still be an overall, right, 3-wave corrective decline, ABC, at which point maybe a larger degree wave 4 on the weekly chart would be formed, and then we'd be going back up and making new all-time highs eventually again in a 5th wave. And again, we'll just have to see what the decline looks like if it is a wave C. Now, if it's a really strong decline and travels, a good 1.618 times the distance or more of this first leg down off of that termination point of wave 2 or B, then we can start considering that, okay, we've got a 3rd wave down. Now look for a weaker bounce in a wave 4 that doesn't overlap with this termination point of wave 1, and then another wave down in wave 5. And then that would be a 5-wave down of larger degree, and again, denoting that the trend of larger degree than that is also to the downside, but it would also set up for a large 3-wave corrective rally. So again, these are all hypotheticals. Right now we're just dealing with information in front of us, and certainly the downside seems like the path of least resistance at this point. What else will I remark on? Okay, let's have a quick look at the NASDAQ composite. Just thought I'd bring that to your attention. So the NASDAQ, it was the only major indice in the US that actually made a new recovery high, okay? So its wave count, I haven't done wave labels on this chart, its wave count is not the same as the S&P 500s or the Dows, but the island reversal here on the NASDAQ is very clear. See that clean space in between those two gaps on either side of this congestion of price? I'll also note you had a nice bearish daily engulfing candle after a doji, and then basically nothing but downside ever since. So that was a very good reversal signal. If you took that trade on the bearish engulfing on that doji, that bear trade, you've done extremely well for yourself. So one thing to say, in previous market tops, so in 2007, and then again, I believe in the early 2000s, 2001 or something like that, the NASDAQ was the last one to peak. So the Dow and the S&P peaked before the NASDAQ, and then the NASDAQ made one final new high. The other two indices failed to confirm that high, made a lower high, and then they all rolled over thereafter. And obviously the NASDAQ is the higher beta index. It's very tech heavy. Tech's been responsible for a very large portion of this bull market. So it's easy enough to conceive that, okay, the final throws of the bulls were for tech to make a new high, the NASDAQ to make a new high, nothing else was able to. And now it's starting to roll over. If that's the case, the NASDAQ should actually become a leader to the downside, just as it was a leader to the upside, because the names are higher beta. They're just more volatile by nature. So, if you have a 50% decline on the S&P and a 45% decline on the Dow, these are just hypothetical numbers from the top, maybe you'll have a 60, 70, 80% decline on the NASDAQ, just the nature of the holdings in it. Anyway, just thought I'd bring that to your attention. So beautiful island reversal, NASDAQ. Oh, by the way, on all the indices, so this is the 8-period EMA, the T-line, that black line there, trading well below the T-line. So wouldn't get too excited as a bull until you at least, again, start trading above that T-line. I know I've mentioned that in Bitcoin analysis videos before. Certainly applies here as well. T-line is a very good short-term kind of a support or resistance area, depending whether you're going up or down. In this case, down, and acting as resistance. Okay, let's look at the Dow. So the Dow was actually the weakest of the indices as far as this recovery high, but the implications are largely the same. Has a similar wave count to the S&P. You can certainly make the case for a 5 down, a 3 up, and now working, maybe another 5 down. So Again, similar to S&P, but a little weaker, kind of leading weakness actually at the moment. We'll see how that plays out. Nothing to remark other than that for the Dow. And the VIX. So clearly, we had that initial spike high on the VIX, went as high as 50.3, and that was the February lows. And then we've had a series of lower highs and lower lows on the VIX, so the VIX has been pulling back, which coincides with the indices making higher highs and higher lows on that recovery. But now we're starting to change that. So we've got the low, high, higher low, higher high, higher low, and then today another higher high. So if we start breaking, say, this spike high in the VIX, which is around 26 and change, you might actually start to think about getting back up to the 40 or 50 level or beyond. So if we have a wave 3 down on the indices, the VIX should probably make a new high above 50. This is another thing to watch as far as judging the nature of the next wave down. Now, if the VIX only makes a lower high, like that or like that, and then starts rolling back down and equities start going back up, that might add some credibility to the overall decline that we're seeing right now just being a C wave. And then after that, we can start to look bullish again. So some interesting things to keep an eye on. Certainly a bad day for a lot of people in the markets, although it doesn't necessarily have to be, depending on how you're trading. Any comments or suggestions? Let me know. Serial Trader signing off.